Welcome to Dennis Money's 2 Cents, your weekly recap of headlines and stories. I am Matt.
I'm Victoria.
And I'm Rabih.
Boom, guys. What are we going to fight about today is the question of the day. But we're going to let it happen organically, as Victoria
It always does.
It always happens. We're going to fight about something. And when I say we, I mean you two. I'm just going to be here to moderate and maybe watch. I brought my popcorn. So here we go. So we have a market update, as always, from Rabih. Rabih, you got to tell us why the market is so crappy right now, as a client put it to me today. I was telling you guys how I got an email from a client, and he was like, hey, so the market's, it was one email, and it just was like, hey, the market's really bad right now. And I was like, yeah.
That's it. That's the whole message.
What do you want me to say? Like, it is. Yeah, I'm sorry. So Rabih will tell us why. We're going to talk. We got another study from your buddy, as we say, Victoria is now the study buddy. So another study from her, again, overachiever. And then if we have time, hopefully we'll have a little bit of time to talk about how Americans are just spending like crazy. Still, nothing is going to stop them from spending money, it seems. So Rabih, let's jump in with what you have on the market.
Let's talk about the market. So over the past couple of episodes, I've been referencing that there's this narrative in the market where stuff outside the stock market are actually influencing it. Given that this is the first episode in Q4, I thought of just let's look at numbers for what the last 3 months have been and see whether the numbers actually fit the narrative or not. And from there, if they do, we can actually try to hypothesize what the economic environment going forward might be. So the whole narrative has been that Americans are still strong consumers, nothing is slowing them down, and global macro events are affecting oil prices. So these two forces together are imposing inflationary pressure on the market, and in reaction, interest rates have gone up. And with interest rates going up, the dollar has been going up, and that has been affecting the stock market negatively. So that was the narrative. But now let's put them into numbers, and you guys can kind of sense the magnitude of it. So let's start with the stock market, because it is the least affected, but it's the one that people look at the most. So how much did you guys think the S&P 500 or the NASDAQ or the Dow Jones, whoever you like, fared over the quarter in terms of return? If you want to make a guess, it wasn't positive, but how bad was it?
How bad was it in Q3?
Yeah.
I want to say 5%.
Victoria, any guess? I want to tell you you're wrong. Just kidding.
This is where we fight.
Just kidding.
I'll go -9.
-9%, which, according to the sentiment we hear outside, your predictions are kind of accurate, but it did go down in September 5%. Matt, you're right about that. But if you include July,
that's what I thought you meant. Oh, that's what I thought you meant. 5% in September. Yeah, let's go with
yeah.
Hit my answer with whatever makes sense. Yep.
Yeah, but if you remember the beginning of end of July, the market was at like the highest it's been for the year for 2023. So when you average all these 3 months combined, the market only dropped, talking about the S&P 500, only 2.5% in the last 3 months. So all this sentiment, all this fluctuation, the market, actually just today, the day we're recording, the S&P is down 1.38% just in a single day, but those are fluctuations, they'll come and go. So even with the sentiment, the equity market didn't really fluctuate enough. But what is causing the sentiment? Let's look at fluctuations in oil and in interest rates and in currencies. And if we start with oil, I'm not going to test you guys on these, but
I mean, I have the answers. I'm looking at the document right now.
Now that I shared the document, oil for the last 3 months is up 26.8%, which, percentage-wise, that's a huge movement. And as a function of increasing oil prices, which is inflationary, market participants anticipate that interest rates are going to stay high for longer. So long-term interest rates are adjusting. And if you are holding a 20-plus year bond throughout the last 3 months, your bond has dropped 14.8% in value. And the shorter the duration of the bond, as we know, the less sensitive it is for higher interest rates. So, for example, 3 to 7, so medium-term treasury bond only dropped like 1.92%. So those are all fueling, and as you can see, like a 20-year bond, which is a long duration and the one that you can most approximate to equities, dropped by 14%, where the equity markets are still sheltered. And as a function of higher interest rates, foreign investors flock in and they want to invest in the high interest USA is providing. And that will put pressure on the US dollar, and the US dollar will appreciate vis-a-vis other currencies. And just throughout the last 3 months, against the euro, the US dollar appreciated 3.7%, against the British pound 4.3%, Japanese yen 3.5, etc. across the board, which just tells us that the numbers are actually fitting the narrative. And this puts us in a position where we are thinking of an economy where consumer is still strong and the job for inflation is still not done. But this doesn't mean more interest rate hikes are coming. This just means that longer term interest rates, which is the interest rates on a 10-year bond, 20-year bond, etc., still do not reflect how high the interest rates are going to stay. And this, phenomenon of incorporating the information into the prices is increasing interest rates across the board and devaluing, stocks and real estate and other assets that are sensitive to interest rates. So from here, where do we go? What do you guys think?
I'm sitting here as you talk about the narrative. It's so interesting, Rabih. There's the numbers aspect of this, and there's the psychology of this, right? And meaning it's almost like the first half of this year was so incredible because it recovered so well from the year prior. 2022, as we all know, was pretty rough in regards to the overall market returns. We then basically matched what happened the year prior, but in a positive territory. I think through July, I want to say, Rabih, I'm going off the top of my head, we were somewhere like 19% or something positive for the S&P. And so it almost works sometimes to a detriment, because to your point, where you have such a positive increase so dramatically, and then it tapers off and it becomes negative. But to your point, if you look at it over the 3-month period, it's like, well, it's not that bad, but it's almost like the starkness of the shift makes it seem even worse. So I'm getting messages from clients being like, oh my gosh, what's happening? It's like, this is actually pretty normal sell-offs. Like the overall drop is not that bad, but I think it feels worse because we had such a positive first half of the year. It's like the psychology of it.
And the sentiment of all of it. And what I find interesting is, like, if the numbers and the narrative match, and we have a certain degree of confidence to say, yeah, this is what's happening in the economy, because you can't know what's happening in the market, but this is what's happening in the economy. You will say, okay, the US stock market is dropping down, not because of something inherently bad, just because of macroeconomic stuff happening in that environment that are revaluing what the value of equity should be. So it's not, a sign that a crash is coming, and it might not be, hey, it's a dip by the dip. It's just a revaluing, a new regime where prices don't have the ability to shoot to the upside like they used to when interest rates were lower. And just tells you that this is the test of what makes a good investor. A good investor, the patience of it, and making sure that they'll have to wait until the economic environment on a global level shifts more favorable of financial assets.
Yeah, like to your point, Rabih, the secret is time, right? And this is looking no further than what we talk about on this show every single week, which is the market is just a big guessing machine, meaning it's just a bunch of participants jumping in there trying to guess what's going to happen. And so again, if you're playing that game of guessing what's going to happen week to week, like you're going to lose. But to Rabih, to your point, if you're patient, if you take the time, or if you use time to your advantage, then over time, over a long enough period of time, it's actually pretty predictable what's going to happen. Guess what's going to happen? The market's going to go up over 5, 10, 15, 20-year period. The S&P 500 has never been negative ever in any 12-year period of time, rolling 12-year period of time. I have Rabih Dimachki here to tell me if that's an incorrect number, but I'm almost positive that that is correct. So Robbie's like, I don't have the data in front of me, so I don't even can't
I don't
question
have
you.
the data, but if
We'll make a
you're wrong,
correction.
you're wrong by like half a percentage point. So you're
There
good.
you go.
I'll give it to you.
We did a webinar on this not too long ago, and we had a bunch of data. I think you helped us gather that, Robbie. And we talked about this, where the data shows that over any 12-year period of time, we've never ever had a negative, so rolling 12 months, or sorry, rolling 12 years. It's never been negative ever. And so, and the average, or no, sorry, the lowest average annual rate of return over any 30-year rolling period, this is annual, by the way, is 8%. So again, just a little bit of perspective there. Right now, it feels kind of crazy. The sentiment feels crazy. I would argue that no matter what period of time you stepped into, from 1926 to today, if you stepped into any time period and you listened to the chatter of what was happening in the market and the news and all that, it would always feel like, man, what is happening? This is crazy. But again, over time, it only goes up. So, Victoria, any thoughts that you have before we jump into your study? Anything in response to this on the market or anything like that?
No, I agree with it. Time is your most valuable advantage when it comes to investing. But I am curious, and maybe this gets more into your topic, Matt, like what would happen if consumer spending like didn't calm down? Like what if we just keep rolling with this?
It's a good question. And we can jump to this if just a natural segue, and then we could come back to the study if you want, Victoria, or finish up with your study. Because that's a totally valid question, I think. And Robbie, I'd love to get your take on that, to that question of like, where do we go from here? Spending spending is not stopping, right? So let's just do this. I think this is a great segue. Victoria's a natural. Look at that organic segue there. Amazing.
No, I'm genuinely curious because I feel like ever since we got out of a COVID environment, people are excited. They want to explore the world again in a completely different energy. And so I don't know, from my perspective, I just don't see that calming down anytime soon. So then how would like all the other factors react to that?
Yeah. It's such a good point, Victoria. And it's so interesting when you talk about the impact of COVID. I'm even going to go back further. The impact of 0809
Yeah.
that is still impacting us today in this sense. So let's hit this really quick, and then I'll come back to that of how the housing market is impacting this. So this article I found in the Wall Street Journal is titled "Americans are still spending money like there's no tomorrow." So I'll just give you a couple of quick hitting numbers here. Americans in August spent 5.8% more than the year earlier. So that's outpacing inflation by, let's see, inflation was 4%. Let's see. It says outstripping less than 4% inflation. So yeah, so inflation was 4%, spending was 5.8%. So people are still spending money despite inflation. It references a couple of things here. So Delta Airlines reported a record revenue in the second quarter of this year. Ticketmaster, thanks Taylor Swift, selling over 295 million event tickets in the first 6 months of 2023. That is up nearly 18% year over year. So this article, we won't go over every detail, but the article goes on to talk about how a lot of the spending happening right now is based around what we'll call the experience economy, right? It's a lot of these experiences, travel, concerts, things like that. And they mention, and I'll come back to this idea of where 0809 is still is having an impact along with COVID. What they mentioned in this article is the tough housing market, and it's very, very difficult, especially for like new home buyers, or like the quote unquote starter home. It's become very, very difficult. What they have found, or what their thesis is, I guess we should say, and it makes sense intuitively, is that people are no longer, like, they're kind of writing off the idea almost of buying a house. Some younger people are.
Yeah.
And they're just like, forget it. I'm going to go to Italy. I'm going to go travel, or I'm going to go spend money on these concerts, or I'm going to go enjoy this once in a lifetime experience. And so again, you talk about 0809 and like everything that has happened since then, including COVID, that has led to the housing market we have now, which in a lot of cases is very, very strong, right? If you own a home, it's awesome. If you don't, not awesome. So kind of an interesting parallel there, and kind of I think an interesting kind of concept of the housing market is almost leading to more spending. What do you guys think? Or Victoria, what are your thoughts on that?
Yeah, I've never thought about it that way before, but I feel like that makes a lot of sense. Like even a lot of folks I talk to around my ages have almost given up on the idea of having a home really anytime soon. So then when you don't have the money kind of going towards that, then it's going to go other places if you're not intentional with it. So Taylor Swift, absolutely. I was there in Las Vegas, day one. So,
Yeah. You were day
I-
one concert?
well, night one
Day one of the
Las.
Vegas show. Got it.
Yes, there were
Because she
2
did
nights
multiple
there.
days. Got it.
Yes. Yeah.
I was like, you were there the first concert? Like, that's pretty wild.
No, I wish that would have been a very legendary experience. But no,
Yeah.
I was in Las Vegas. I was one of the ticket purchasers.
Yeah. Again, it makes sense. I'm sitting here thinking, think about you putting money away. Let's say you saved a bunch of this money for a down payment of a house, and then COVID happens, and then rates double, right? Which they
Yeah.
doubled, and so the cost of that, or the down payment money you now have, is not going to get you to the house that you were maybe going for. So that seems so much further off into the distance.
Totally.
Victoria, like, I can totally see it. Someone just being like, forget it. I'm not going to do this right now. I'll push it off a few more years. You kind of push that goal out of your mind. And then again, you're like, let's go travel. Let's go to this concert. Let's go spend money on what XYZ experience.
Yeah.
Sense.
It became way more unattainable. And I mean, I feel like this also ties into like why it's so hard for younger folks to save for retirement. It's like further away, and the further away something is, the more difficult it is to prioritize in your mind normally. So then with where the housing market's going now, that's pushing that even further back. So there's less of that drive or desire to want to have it, and so you want to have more short-term I don't know, pleasures and experiences. So that makes complete sense to me.
Yeah. And I think if you double this down on like the mentality anyway, the mentality shift, I think that was probably accelerated because of COVID, but I think of younger people in general. There's a quote here from Michael, I'm going to mispronounce his name, Lurch. He says, speaking of the spending that we're talking about right now, he says, it's not regret-filled spur of the moment decisions. It's the opposite of that. It's where I would regret not having done it. So he's referring to, again, this experience level economy. I think that's more of a mindset of younger people today. Anyway, I think despite what's happened in the housing market, I think there's studies that out there that are showing that people have been delaying that. Like younger people have been delaying things like buying a home anyway. And then again, they get more expensive. So back to your question though, Victoria and Rabih, I'd love to get your take on this of like, where do we go from here? And I know I'm asking you to predict, and maybe I won't ask you, I'll ask it another way. What happens if this just continues for the next 6 months, 12 months, 2 years? Like, what happens if we don't stop this spending with the level that it's at?
I'm going to give you a slightly academic answer, but
love it. Love it.
But the framework applies to both questions, whether we're talking about the general level of the economy where people are still spending and where do we go from there, and to the question about houses are, where they are and where do we go from there. Both of them, their answer is related to supply and demand, because our economy works in terms of equilibrium. So when we are talking about houses being expensive and homeowners versus non-homeowners are having a different financial experience, a balance has to be struck between the lack of supply that is in the market that is pushing house prices up, and the unaffordability of houses right now, just because not everyone can buy these houses. And as more people start making decisions whether to buy or to defer a house purchase, whether it's a rational or irrational decision, it's a different question, will try to filter out and balance and create this equilibrium in the housing market. So a new equilibrium will happen. And when we say equilibrium, I think most of the time people mistaken it to the old days when everything was stable. No, we'll find a new regime of stability with like different parameters for it. So for the example of everyone is still spending a lot of money on an economy-wide basis and inflation is there, where do we go from here? It just means that we are going to go to a new regime where people are still going to be spending as much as they do. They're not going to revert back, but inflation will not be there because other factors went up and created an equilibrium. And those other factors might be the interest rates. There might be a new natural level of unemployment that exists in the economy. Right now, when we think of, the economy is stable, it's at equilibrium, is what we experienced the last, 10 years, where unemployment was at 3.5% for God knows how long, right? That was kind of in our mind, the equilibrium. And new equilibrium might be, yes, consumer spending is going to grow 5 and 6% each year, but unemployment might stabilize at 6 for a prolonged period of time. And that's a new regime, a new type of equilibrium. And this is where we would go to. We would go to a new equilibrium. It doesn't mean that we have to go back. It's just a new equilibrium where we can still transact and keep the economy going forward.
It's interesting you say that, Rabih, because my dad, I think I mentioned this before, but my dad's been in real estate for 40 years. He's been an appraiser, an investor. And so he remembers back back in the 70s and 80s when he was doing it back then. He remembers, I think his first home purchase, he said his mortgage was like 18%. And so it's just, or something in that range. It's just interesting that, to your point, and again, this is something we've mentioned, that right now, 7% are where rate, just speaking of mortgage rates specifically, they seem so crazy right now because we are anchored to the old equilibrium. We're anchored to the old baseline. I have some clients who literally got a 30-year mortgage below 3%. Like, that is wild, right? And so now we talk to people and they're like, oh my gosh, rates are so expensive. It's like, but I wonder how long it's going to take until that becomes, again, the new normal, the new equilibrium. And then all of a sudden, what's interesting is all of a sudden, let's say rates drop down to 6 at some period of time. And now 6 is going to feel so cheap. It's going to be like, oh my gosh, rates just dropped to 6%. That's crazy. It's like, but in 2019 or 20 or whatever it was, oh gosh, there's the thumbs up. Guys, I can't make any gestures. If I do, I'm so like, I talk with my hands so much, and then I've got the Zoom things popping up. I'm sorry. Anyone that's watching live knows what I'm talking about. If you're listening on the podcast, I've got little things, bubbles popping up in my Zoom. Anyway, we will move on. Right now, to summarize this, there is no end in sight. It looks like, from a spending perspective. We do this every week. I think we see a new report every week where people just keep spending money. Americans love spending their money. I guess maybe we'll do this next time, Rabih, where we can kind of take the other side of that discussion of what happens if/when spending does stop. 70% of GDP. We probably should, hit that on maybe the next discussion. But
that's your teaser. Yep.
Yeah, there's our teaser. There's our teaser. We'll come back. I want to get to this, at least have a summary of our study buddy, Victoria. She puts so much time and energy into these. Probably not, though, to be honest, because she's so freaking smart. She probably just breaks it down in 10 minutes. I look at her notes and I'm like, this would take me 2 weeks. But Victoria, let's break this down. Talk about this study that you have.
Yeah, definitely. Well, this one came out just last month from Wharton. And basically, it just examined how financial education actually affects financial outcomes and if it is actually helpful for folks. So essentially what they did is, out of all the participants, anywhere, I think they're 25 to 80 years old. So wide range of folks. What they did is they gave them the task to make an asset allocation based on, I think they gave them $30 and they said, you go and invest this $30. And so they went and did that. And they were going to be tasked to do that again. But before they did it, they had the option to receive financial education. So they kind of wanted to see who was actually electing to have financial education before they made that second allocation. And so there were some interesting findings on that. And I think what I found most interesting, and I feel like this makes sense, is people's main driver to get financial education is knowing that they're going to have higher returns in the end. And I feel like that makes a lot of sense for me, because I feel like I get asked that, all the time. It's oh, well, how well are the investments doing? And people really focus on the investment piece. And that is just a part of what we do. And to take that a step further, the people who were electing to get the financial advice were people who were kind of deemed as already financially literate. So if you were already more sophisticated and financially literate, you knew that investing in your education was going to be a lot more valuable. versus somebody who was not as financially literate and probably needed it more so, was less likely to. And also you all have the folks that are very confident, the self-taught individuals that claim that they're very financially literate and confident with it, were like the least likely to take it on, and they actually performed worse. So
I was going to say,
I feel like
did it
this
lead
made a
to
lot
them
of
making?
sense.
Yeah, like did they talk about how that led to worse performance of those people, the overconfident folk?
Yeah, they talked about that. They had all the numbers with it, and I won't go into all the details, but
Yeah.
yeah, that it performed worse for them.
That's interesting, and it makes sense intuitively that a lot of times it's like you could argue that just the more education
Mhm.
just leads to more confidence, but not necessarily better decision making. Like those are all not, like, the higher education does not lead to better decisions. Is kind of what I'm gathering from this, from an investment standpoint.
Yeah, definitely. And I think like also what was interesting too is even if the financial education was free, there was like 25% of people who still didn't want to have it. So I should mention that the catch to it is you would have to use some of your second allocation, some of that $30 to like buy the financial education.
Got it.
So that was
Got it.
that was a bit of the catch too. Yeah.
And was there, and maybe it doesn't say this, but was the financial education specifically with investing, or were you talking?
Yeah.
Okay,
This is just like
specifically around
investment
investing.
specific. So I think it was like on diversification and like risk adjusted return. So a couple of just two topics within it.
Got it.
Robbie's
Got it.
smiling.
Robbie's smiling here.
Here's why I'm smiling. They're also slightly academic answer, but there's something very interesting in all the stuff that we learned about in finance, like the efficient market hypothesis, where all prices are instantly reflected in, or information is instantly reflected in current prices, or risk mean optimization to like diversify your portfolio. All of these models that the whole finance world is built upon have in their assumptions assume a rational investor, like in bold,
Yes.
right?
Yeah.
And most of the time, like all these academic models, they are saying this is the best case scenario, and to get the best case scenario, you need everyone to act rationally. But in reality, not everyone does, and that exact study shows that it's not. So I think the whole world would be better if everyone just learns it and applies what's in the books, and then we move forward. That's why I was laughing. It's like,
It's funny. Yeah, it's so true.
Too close yet too far from an
Well,
ideal word.
This is what makes all of this so difficult, right? To your point,
Yeah.
like even the academic aspect of it, Robbie, which I know you know inside and out, is like you, like you said, you're banking on, or you have to attach a variable to that, and that variable being that people are rational, and we know that people are not. There's actually a book, Robbie, you probably read it. I think it's called Finance for Normal People. Anyway, it talks about this very thing, about how a lot of these academics, like, great, you've got all these formulas, they mean nothing because most participants in the market are not rational. So, Victoria, anything else to wrap up on this? Any other final thoughts on this study?
Yeah, I guess the last thing I'll say, the one thing that did give me hope with this as a financial advisor is
Ooh, I want to end with hope. Yes, I like this.
Well, I'll end on a happy note. So of the folks who did elect to receive the financial education, I think it was half of them decided to shift how they allocated their
So they actually
second.
listened.
So there's about half of them that actually listened. So maybe that means at least half of my clients listen to me. That would be great. I'd be happy with that.
That's a pretty good ratio. Yeah. And that's a really, really good point, Victoria, of saying, like, it's one thing to get educated. It's another thing to take action on that education and actually try to apply it.
Totally.
Which, again, why this is so hard. You can be super educated. You can know all the ins and outs of this. You can know all the formulas. Doesn't mean that you're going to act rationally, right?
Totally.
Robbie, we were just saying, I know there's other aspects of this, but we were just talking about like the emotional toll the markets can have. You were mentioning about yourself, but it is a good point. Like, it's so emotional when your money's attached. Money is simply just a reflection of your values, your goals. Like, it represents something. So when you're seeing it fluctuate, it can be scary. It can be very, very emotional. And we've seen a lot of smart people, because that's the only type of people we work with, are smart dentists. And we've seen a lot of smart dentists make a lot of bad moves in the markets. So this actually applies so well, Victoria, to our demographic of people we work with, smartest people in the world, and they still make a lot of bad decisions because, again, that emotional side of things. So guys, we got out of here without a fight. So we have turned a corner, I think, in this 2 cents with Rabih and Victoria, and a little bit less spicy though. We got to bring it back next time. We'll try to get a fight going somehow. I'm gonna like start picking. I'm gonna start a fight of some kind for the entertainment.
Until next time, Rabih.
Until next time. So, all right, everyone. Thank you so much for listening. If you're watching live, we appreciate you. If you're listening over the weekend, thank you so much for listening. That was our 2 cents. Bye bye now.